Okay, I want you to picture the AI revolution for a second. Just, close your eyes. What do you see?
Usually I see code, I see chatbots writing poetry, or maybe generating some surreal image.
Right, or Jensen Huang in a leather jacket holding up a new NVIDIA chip?
Exactly. We're all obsessed with the brains of the operation, the silicon, the software.
We are, but today we're going to completely ignore the brain. Today we're looking at, well, the lungs and the heart. We're looking at the massive, heavy physical infrastructure required to keep those brains from melting down.
We're talking about the part of the AI story that involves concrete, copper, steel, and honestly, a frightening amount of electricity.
And to do that, we're doing a deep dive into a company that, on the surface, might sound like a boring, century-old industrial giant, Eaton Corporation.
Mm-hmm.
But the earnings report they dropped this morning, Tuesday, February 3rd, 2026, it is anything but boring. Honestly, some of the numbers in here are barely believable.
It really is a pivotal moment. And I don't use that phrase lightly. This isn't just a quarterly update. It's a signal that the industrial phase of AI has officially started.
We have so much to get through. We have a massive corporate breakup, the Great Divorce, as I'm calling it.
Right.
We have a 200% explosion in data center orders. And we have a $9.5 billion bet on liquid cooling.
Yeah. And we also need to parse why, despite all that good news, the stock is actually down a bit today. There is a lot of nuance here.
So the mission here is simple. We're going to unpack Eaton's Q4 2025 earnings, their slide deck, and the press release to understand how this legacy company is fundamentally rewiring itself and the world to handle the AI boom.
Let's do it.
I want to start with the number that made me spill my coffee this morning. Data center orders.
The 200% number.
Yes. Data center orders are up approximately 200% year over year. I mean, that's in the report. Is that a typo? Did they just add an extra zero by accident?
It is not a typo. And to be clear, that is specifically for their data center vertical. Overall orders for Electrical Americas were up 16%, which is already a very, very healthy number for an industrial company.
For sure, 16% is great.
But the data center slice,
Yeah.
it's just... It's exponential.
But how do we even contextualize 200% growth in a physical industry? If a software company grows 200%, that's just people downloading more apps. But this is switchgear. This is heavy machinery.
You can't just download a transformer.
Exactly.
That's the key difference. This is a signal of a generational shift in power usage. We aren't just seeing a bump in demand or some little quarterly spike. We are seeing a complete rewriting of the order book. And there was a detail in the earnings call that frames this scale even better than the percentage. Did you catch the 11 years comment?
I did, and I had to read it twice because I thought I misunderstood it. The CEO, Paulo Ruiz, was talking about the backlog for data center construction.
Right. He cited data from the Dodge Construction Network. He said that at the current rate of building, which is already frenetic, by the way, the backlog of data center projects represents 11 years of work.
Okay, stop there for a second. Let's really unpack that. So if we stopped ordering new data centers today, if Amazon, Microsoft, and Google just put down the phone and said, we're good, we would still be pouring concrete and installing breakers for the next 11 years.
Theoretically, yes. That is the sheer volume of the queue. I mean, the industry is currently tracking something like 866 mega projects, and the total value of these projects industry-wide is hovering around $3 trillion.
$3 trillion. That is just... It's hard to wrap your head around.
It is. And for Eaton, this isn't just a good quarter. This is job security for a decade. It means the demand curve isn't a spike. It's a plateau that just stretches out towards the horizon.
But here's my skepticism. We've heard about backlogs before, that, they vanish when a bubble bursts. Is this real demand, or is this just people panic ordering because they're afraid of missing out on AI?
That's a fair question. Panic ordering or double ordering is a real risk in supply chains. But look at the composition of the demand. This report gave us a really interesting look at the cloud versus AI mix.
Yeah, I saw that chart. In 2025, revenue, so the stuff they actually got paid for, the split was roughly 70% cloud and 30% AI.
Correct. So historically, most of Eaton's money came from standard cloud servers. Your email hosting, your file storage, your Netflix streaming servers, standard stuff.
But look at the orders.
Exactly. In the 2025 order book, the stuff that's coming down the pipe, it has already flipped to 50-50. AI has caught up to cloud in the span of a single year.
That is a wildly fast transition for an industrial company. I mean, usually these shifts take 5, maybe 10 years.
It is, and the implication is that AI is going to take over the pipeline completely in the next few years. And this matters because an AI data center is not the same beast as a cloud data center. It's physically different.
How so? I mean, a server is a server, right?
Not anymore. AI data centers are denser. They require way more power in a much smaller footprint.
Yeah.
And crucially for Eaton, they run much, much hotter.
Yeah.
Which brings us to the biggest strategic move in this report.
The acquisition of Boyd Thermal.
The $9.5 billion bet.
Okay, before we even get into the tech, just purely as a business move, spending nearly $10 billion when you're an industrial manufacturer is a massive swing. They're buying this company called Boyd. Why?
They view it as essential survival. Here's the problem. We know AI chips, like the NVIDIA Blackwell series or whatever comes next, are pushing the absolute limits of physics. You cram that much computing power into a GPU and it just generates an immense amount of heat.
Right.
Traditional data centers use air cooling, big fans, what they call CRAC units.
Yeah.
Basically just blowing cold air on the servers like you would with a desk fan, but, bigger.
Sure.
But with these new AI chips, air doesn't work anymore. The heat density is just too high. Air is too inefficient at moving heat away. You need liquid.
Okay, so Eaton sees the writing on the wall. But Eaton makes circuit breakers and power distribution units that don't make air conditioners.
Exactly. And that's where the distinction between the inner loop and the outer loop comes in.
Yeah.
The CEO spent a lot of time explaining this because it's the core of their new strategy.
Can you break that down for us? What is the inner versus outer loop? It sounds like highway infrastructure.
It's not far off. Think of the outer loop as the big infrastructure outside the building or on the roof. Massive chillers, huge cooling towers. Eaton partners with companies there. They don't want to build chillers. That's a commoditized market.
Okay, so they stay out of the yard.
Right. The inner loop is the intimate cooling. It's what happens inside the server rack right next to the silicon. We are talking about cold plates. These are metal plates with liquid channels inside them that physically sit on top of the NVIDIA chip.
Wow.
And we're talking about coolant distribution units, CDUs, that pump the liquid right to the rack.
So it's basically the plumbing inside the computer?
Ideally, yes. That is the inner loop. That is what Boyd Thermal does. They are the leaders in that specific high-tech plumbing.
So by buying Boyd, Eaton is trying to get as close to the chip as possible without actually making the chip.
Precisely. And the synergy is the holy grail here. Before this, Eaton controlled the power coming into the rack. But once that power turned into heat, it was someone else's problem. Now, if they control the power coming in and they control the heat being pulled out via Boyd, they own the entire ecosystem around the GPU.
They encompass a chip. And I'm guessing that ecosystem is worth more money than just selling a circuit breaker.
Much more. They actually did the math for us in the slide deck. With a traditional data center, just air cooling Eaton's accessible market was about $2.9 million per megawatt of power.
Okay, 2.9.
With AI and this new liquid cooling portfolio from Boyd, that opportunity jumps to about $3.4 million per megawatt.
So every new data center built for AI is worth $500,000 more per megawatt to Eaton than the old ones.
Correct. And remember that mega project backlog we talked about? Just multiply that extra $500,000 by gigawatts of capacity. The revenue unlock is massive.
There was a great moment in the Q&A section of the call where someone asked about NVIDIA's new chips running hotter. And usually in engineering, heat is bad. Heat is inefficiency. Heat breaks things.
But for Eaton, heat is gold. The CEO basically said that even as chips get more efficient per calculation, the absolute density is going up. The hotter the chips get, the more it forces data centers to abandon air cooling. It effectively forces them to become Boyd customers.
So bad for the polarized caps, good for Eaton's bottom line.
In a cynical sense, yes, but also look at it this way. Without this efficient liquid cooling, AI simply stops working. The chips would throttle instantly, so they are solving the critical bottleneck that allows AI to exist.
Okay, so we have the boom, we have the tech to handle it, but we can't ignore the other massive headline, the Great Divorce.
The spinoff.
Eaton announced the Execute for Growth strategy, which is, it's a fancy corporate way of saying they are splitting the company in two. They are spinning off the mobility business into its own public company.
Yes.
I have to ask, why? I'm looking at the financials. Eaton had record revenues in 2025, $27.4 billion. The mobility business, which is truck transmissions, powertrains, valves, it makes money. It's profitable. It's reliable. Why kick it out of the house?
It comes down to a concept investors are obsessed with called the pure play.
Explain that for us.
Think of Eaton's portfolio like a race car towing a trailer. The race car is the electrical and aerospace business. These are high-growth, high-margin sectors tied to massive secular megatrends like AI, the energy transition, electrification.
Right.
They trade at high valuations because everyone wants a piece of the future.
That's the sexy part of the business, the rocket ship.
Right. The trailer is the mobility business. It makes truck parts. It's a solid business. It generates cash, but it's cyclical. It goes up and down with the global trucking market. If fewer trucks are sold, revenue drops. It drags down the valuation of the whole company because investors don't know how to price the mix. They don't like complexity.
So by cutting the trailer loose, the race car can go faster.
Exactly. By spinning it off, legacy Eaton becomes a focused powerhouse purely on electrical and aerospace. They can tell Wall Street, look, we are 100% focused on the high-tech power grid and flying. No distractions.
And this isn't the first time they've done this, right? It feels like they've been slimming down for a while.
No, it's actually the final step in a long transformation. They spun off lighting in 2020. They sold hydraulics in 2021. They have been slowly shedding their old industrial skin to become a technology company.
It's almost like a corporate molting process.
That's a vivid image, but yes. And the CEO made a good point about capital allocation. Inside a massive conglomerate, different divisions are fighting for money. The data center business needs billions for factories right now. The truck business might need money for retooling.
And the data center business is always going to win that argument because the growth is 200%.
Exactly. So the truck business gets starved. By spinning off mobility, that new company keeps its own cash. It can focus on its own battles without having to beg for scraps from the AI table. It's actually better for the truck business, too.
Okay, so strategic alignment makes sense. But let's look at the immediate reaction. The stock is down today. If everything is so great, 200% orders, smart acquisitions, focused strategy, why are people selling?
It's the classic growing pains story. We have to look at the Q4 financials and the guidance. They actually missed revenue expectations slightly. They came in at $7.06 billion, and the street wanted $7.15 billion.
And miss is a miss. Wall Street hates uncertainty.
It is, but the bigger concern for some investors, the nitpicky ones, was the margin squeeze in Electrical Americas. Operating margins dropped 180 basis points to 29.8%.
Okay, define basis points for everyone and explain why a drop to 29.8% matters. Because to me, a 30% profit margin sounds incredible for a factory business.
It is incredible. Most industrial companies would kill for 15%, but a basis point is just 1/100%. So a 180 basis point drop is a 1.8% drop. It's significant when you are priced for perfection, like Eaton is.
So what caused the drop? Did they get inefficient? Did they lose pricing power?
No, it's actually the opposite. They are victims of their own speed. The CFO called it front-loaded ramp costs.
Which means?
It means they are spending money before they make money. They're spending $1.5 billion on capital expansion. They have 24 different capacity projects running simultaneously, building new factories, expanding old ones.
So they're hiring workers and building walls, but those factories aren't shipping products yet.
Exactly. You have to hire the people to train them. You have to buy the machines and depreciate them. That shows up as a cost today, even though it generates profit tomorrow.
So the margins look worse because they are sprinting to build capacity to meet that 200% order spike.
That's exactly how the CEO framed it. He called it a good challenge to have. He actually mentioned they are deploying tiger teams to these critical sites.
Tiger teams. I love that. Sounds like a special ops mission. What does a tiger team do in a factory?
In a corporate sense, it is special ops. These are specialized groups of experts, engineers, supply chain gurus, process architects who parachute into a factory that is struggling to keep up with demand. They debottleneck the lines, they fix the workflows, they optimize the shift schedules. It shows management is taking the execution risks seriously. They know they have the orders. Now they just have to physically build the stuff without blowing their budget.
And speaking of budget, I noticed something else that might have made investors grumpy. Share buybacks.
Suspended for 2026?
Usually, Wall Street loves buybacks. It props up the stock price, returns cash to shareholders. Why stop?
It's a signal of where the cash is going. It's going into the business, that $1.5 billion capex, and it's going to close the Boyd Thermal deal, which requires $9.5 billion in cash.
So they're saying, we aren't going to artificially prop up the stock. We're pouring every single dollar into growth.
It's a very aggressive stance, but it's a confidence stance. You don't spend $13 billion in a year between Boyd and other investments unless you are absolutely sure the demand is durable. You don't build a factory for a fad.
Right. If they thought this was a bubble, they'd be hoarding cash. Instead, they're spending it.
Exactly.
Now, before we wrap up, we cannot ignore the other engine. We've talked so much about data centers and the spinoff, but there's another part of the new Eaton that is quietly crushing it. Aerospace.
It really is. In any other year, aerospace would be the headline story. Orders are up 11% on a rolling 12-month basis. Backlog is up 16%.
And they just closed another big deal there too, right? Ultra PCS.
Yes, they bought Ultra PCS for $1.55 billion. This closed back in January. And this is critical because it adds high-tech defense capabilities, things like stores ejection.
Stores ejection. That sounds technical.
It's military speak for dropping things off the plane. Bombs, fuel tanks, missiles. You need incredibly precise pneumatic systems to ensure a missile drops safely when you're flying at Mach 2. That's what Ultra PCS does.
And I assume the margins on dropping missiles safely are pretty good.
They are fantastic. Aerospace margins expanded to 24.1%. This is a massive profit driver that acts as a ballast for the portfolio. So even if the data center market takes a breather, which doesn't look likely, aerospace is there to carry the load.
It seems like they are positioning themselves to be indispensable in the two places where the physical world is getting most complicated.
Yeah.
Powering AI and flying advanced aircraft.
That is a great way to put it. They are moving away from generic industrial to mission-critical tech. If Eaton parts fail, the data center melts or the plane can't fight.
So let's bring this all together. We've got the split, the boom, the heat, and the investment. What is the so what for someone listening to this deep dive?
The so what is that we need to stop thinking of AI as just software. This report is the receipt. The AI boom has officially moved from the software phase to the industrial phase.
It's tangible now.
It is. We are seeing trillions of dollars of physical commitments, concrete, copper, liquid cooling being ordered right now. You don't have an 11-year backlog of construction for something that's a vaporware bubble. Or if it is a bubble, it's a bubble made of steel and reinforced concrete that's going to take a decade to build.
And Eaton is fundamentally changing its DNA to match that reality.
Yes. They are betting the entire farm, shedding the trucks, spending the cash, hiring the tiger teams on this future. They are declaring that the future is electric and it runs hot.
It's a bold move. And honestly, hearing about that 11-year backlog again, it leaves me with a burning question. If the backlog for data center construction is already 11 years long and the power density of these chips is only increasing, are we approaching a physical limit? Like not a computing limit, but a physical limit where the grid simply cannot keep up with the algorithms.
That is the trillion-dollar question. The constraint on AI might not be how smart the model is, but how fast we can build the plug.
And if that's the case, does a company like Eaton, who controls the power management and the cooling, effectively become the gatekeeper of AI progress? Does the speed of AI evolution depend on how fast Eaton's tiger teams can clear a factory bottleneck?
It's very possible that the bottleneck for the next decade isn't silicon, but the copper and the coolant that surrounds it.
Something to think about next time you ask a chatbot a question. It's got to stay cool somehow.
Indeed.
That's it for today's deep dive into Eaton's massive bet on the future. Thanks for listening, and we'll catch you on the next one.